Hi traders, this is Gomathi Shankar and happy to meet you all in a new video. In this video, we are going to see about investing part 2. Before going to today's video, if you have not yet subscribed to my YouTube channel, hit that subscribe button and turn on the bell notification. Now we will see a quick recap of investing part 1. In investing part 1, we saw traditional methods of investing, and in traditional methods like depositing your money in FDs, buying gold ornaments, real estate and much more, you can expect only 7% returns. But when you approach new age investing avenues, you can generate more than 7% returns per annum. And only you can achieve that if you have the right mentor and a good financial knowledge. In new age investing avenues, first we saw about investing in equity stocks. And I also taught you a very good method, a unique pattern to invest in companies based on technical analysis. If you have not yet watched my investing part 1 video, don't forget to watch that first before getting into this video. I have provided the link in the description below, or you can check out that video here. I hope you might have made use of it. So now in this new age investing avenues, we are going to see about bonds, and then we will see about debentures, and then we will see about investing in mutual funds. First, we are going to see about bonds. What is a bond? Bond is like borrowing money from a person and returning the same money after some certain time period along with the interest. Generally, bonds are issued by companies. When a company issues bond, we call it as corporate bond, and even government borrows money from the public, and we call that as government bonds or government securities. Now, when you invest in bonds, it is safe because the bond is backed up with the assets of all the companies as well as the government. So when you invest your money in bonds, even though if a company defaults by not repaying the money, the government will interfere and they will sell those companies' assets to return back you the money. Now the bonds are generally invested based on the credit ratings. Okay, we call it as credit rating agency. And what they do, they will analyze the bonds, they will analyze the companies, and they will give the ratings. Whether we can invest in that particular bond or not, is that bond safe or risky? These kind of activities are done by credit rating agencies. The main credit rating agency which everybody looks upon is CRISIL and India Ratings and Research Private Limited. There are many rating companies, but these two are most approached. Generally, bonds will be giving you a return higher than 8%. 8 to 10% or even greater than 10%, it depends upon the bond. And if you are interested to invest in bonds, then you can contact your stockbroker. He will guide you to invest in bonds. Now let us talk about debentures. Debentures are similar to bonds. We will be lending money to the borrowing company, and they will return back the money after some certain time period along with the interest. There are 3 types of debentures, namely fully convertible debenture, partially convertible debenture and non-convertible debenture. When you invest your money in fully convertible debenture, at the end of maturity, you can convert the returns as well as the initial money into shares of that particular company. And if you invest in partially convertible debenture, half of the amount you can get it as a cash at the time of maturity, and the remaining money you can get it in the form of company's shares. And in non-convertible debenture, you cannot convert the money which you lended into shares, and you can get it back in terms of cash only. Now, this debentures investing is risky because when you invest in debentures, the company assets are not backed. So if the company fails to return back your money, then you cannot get back the money. If the company defaults, then you cannot get back the money at any cost. Okay. The main difference between bonds and debentures are, investing in bonds is safe because the company's assets are backed as a security, and in debentures the company's assets are not backed and there is no security at all. So in bond, when a company defaults, the company's assets will be sold and the money will be returned back to you. And in debentures, if the company defaults, your money is under a question mark. And even if you want to invest in debentures, you can contact your stockbroker and he will guide you. Usually, debentures returns are much higher than the bond returns. Now let's talk about mutual funds. All the people will be investing their money in a particular mutual fund. All the money is combined and a person called fund manager will be managing our funds by investing in the best companies or in the best bonds. So when you invest in mutual funds, you can be tension free, because when you invest yourself in equity stocks, you need to track the company regularly. You need to read the balance sheets, profit and loss statement, cash flow statement, which is already explained in my fundamental analysis course. And when you invest in bonds, you don't know how to check the rating and where to check the rating. And even when you invest in a bond, you don't know when you can exit, what is the lock-in period, what is the yield to maturity. So these are the difficulties faced if you invest in equities and bonds by yourself. But when you invest in mutual funds, you just park your money safely in a highest rated fund, and the fund manager will take care of your money. He will be skilled, he will be having a lot of experience in managing the funds, so your money will be absolutely safe. There are lots of funds in mutual funds, but let me simplify and tell you some basic funds which is safe for every retail person. So the first fund, if you prefer to invest your money in equity stock market, then you can prefer large cap fund. When you invest in a large cap fund, you are investing in the top company of the industry. For example, your money will be parked in Reliance, Hdfc Bank, HDFC, L&T, Infosys, TCS. Like this, your money will be parked in the largest capitalized companies. So if a company defaults, in case if any of the top company, let's say there are 10 companies in a particular fund, and even if any one of the company defaults, immediately the fund manager will remove that particular company from his portfolio and he will add a similar company to replace it. Your money is totally safe and the fund manager will take care of such situations. Investing in a large cap fund is safe when you, instead of investing your money in equity stock market. Now I am going to show you how to select a large cap fund. You just type for large cap fund money control. So as soon as you search for large cap fund money control, the first link you have to select it and you will be redirected to money control website. So here is the equity section. Under the equity section, we are looking for large cap fund. You can read out the definition here. These mutual funds select stocks for investment from the largest 100 stocks listed in the Indian market based on highest market capitalization. So larger stocks are expected to be less risky, whereas smaller stocks may be having the higher growth potential. But even larger companies are expected to give a good growth in the future. Okay, TCS, Infosys, Hindustan Unilever, and HDFC Bank, Reliance, they are large cap funds, but still they are having a good growth potential, right? So here you can see the list of funds which are having invested in large cap companies. So here I am going to select the best fund based on asset under management. So I have selected the asset under management based on descending order. So there the first fund is ICICI Prudential Blue Chip Fund. Here itself you can see the returns. Okay, if you have invested in this particular fund for 3 years, you would have generated 12% return. And if you have invested in this particular fund for 5 years, you would have generated 16% return. So let us analyze about this ICICI Prudential Blue Chip Fund. This large cap fund is also called as blue chip fund. Okay, so here you can see the graph of this particular fund, and here you can see the returns. So as we saw earlier, the 3-year return is 12% and the 5-year return is almost around 16%. You can also check the SIP return. For example, let's assume you are investing 1000 rupee every month in this particular fund. So for 3 years you will be investing 36 months, you would have invested 36,000 rupee, and now the value will be 49,000 rupee, and your annualized return is 21%. So every year you are generating 21% return from this particular fund. You can also check the portfolio of this particular fund, in which are the companies this fund is holding the stocks. Okay, so the top 10 stocks in this particular fund's portfolio is Infosys, HDFC Bank, ICICI Bank, Reliance Industries, Axis Bank, Bharti Airtel, HDFC, L&T, HCL Technologies, and SBI Life Insurance. So this large cap fund, ICICI Prudential Large Cap Fund, has invested all our money in these companies. So if any one of this particular company defaults, immediately the fund manager will remove that particular company and he will do the necessary adjustments. Okay, so you can also read more about this particular fund. Okay, you can just go through about this. The fund manager of ICICI Prudential Blue Chip Fund is Anish Tawakle and Vaibhav Dushant and Rajat Chandak. So you can check more details about this particular fund. Like this, you can go through any fund and you can invest in this particular large cap fund. So this is how you select the best fund in the mutual funds category. The second mutual fund which I will suggest you is bonds. Let's say you are interested to invest in bonds. Some people will say, sir, I don't want equity funds. Whether it is large cap, whether it is medium cap, whether it is small cap, I don't want to invest even a single rupee in equity stock market. So those kind of people can prefer investing in mutual funds, bond market. We call it as debt funds. Debt funds. So among that particular category, the first fund which I will suggest you is corporate bond fund. This corporate bond fund, your money is invested in the highest rated companies and your money is parked in those companies. So when you invest in a corporate bond fund, your money is absolutely safe because each and every rupee of your money is invested only in the highest rated bond. And the second fund which I will suggest you is gilt funds. Some people will say, sir, even I don't want to invest in a corporate bond fund. Then you can prefer investing in gilt fund where your money is invested only in government bonds. See, when you invest your money in corporate bond, you will get some higher returns. People will say that is risky, but that is not at all risky because your money is parked in highest rated bonds which belongs to top companies only. So the fund manager will take care of your money. You no need to worry at all. And when you invest in gilt funds, your returns will be somehow lesser than the corporate bond fund, but still it is better than the normal FD and real estate returns. So gilt fund will suit for everybody. That is safest in the country. Gilt fund is considered to be the safest investing instrument in the country, which belongs to mutual fund category. Now let me show you how to search for a best corporate bond fund. In Google, what you have to type is corporate bond fund money control. Okay. So the first link which you see from the money control, you have to click that. Now at the top, you can clearly see all the types of funds. Okay. Now here we have selected the corporate bond fund. Now here you can look at the definition. These mutual funds are invested in highest rated bonds issued by corporates. Investors who want to invest money for a longer duration but prefer less riskier assets compared to equity fund. When you invest your money in equity fund, the risk is higher. But when you invest in a bond fund, your risk is much lesser than equity fund. Now here you can see a lot of funds which are investing in corporate bond. Now here what we have to do is we have to select a fund which is having the most number of money in their asset under management. Okay, so here you can see AUM, asset under management. There you have to select the fund which is having highest funds, Hdfc corporate bond fund, because Hdfc corporate bond fund is having a very good star rating. It is having a 5-star rating, and if you consider investing for 3 years in this particular fund, you are getting almost 9% return. Okay, you are getting 9% annual return. So that is a good return compared with FDs, right? So this is how you choose a fund. In the same category, you can see a fund name called gilt fund. Just click on that gilt fund, and here you can see the definition. These mutual funds invest mostly in government bonds. Government bonds are considered the safest investment in the country. So anybody can opt for this particular fund. The same way, I am going to filter out the fund which is having more asset under management. So here I can see SBI Magnum Gilt Fund. So I am clicking on that. So look at the returns. For past 1 year, for past 2 year, for past 3 year. So for past 3 years, this particular fund is giving almost 10% return, and you can also see the SIP return. If you have invested 1000 rupee every month for 3 years, your investment will be 36,000, and now it would have grown 41,000. Okay, and you are getting 9% returns very easily. You can also see the portfolio. This particular fund is invested in government bonds and treasury bills, and that is the weightage which we are seeing here. So this is how you choose the best gilt fund under gilt funds category. Now you all might have been aware of new age investing avenues. I have taught you equity, stock market, technical analysis unique pattern for investing. I have taught you about bonds and debentures, and I have taught you about mutual funds, and in that particular mutual funds I have suggested you the best funds as well. Now remember one point, I have not taught you anything regarding yield to maturity and what is the coupon rate of a bond, whether a bond is giving you a higher returns or not. I have not covered the theoretical part of any investing avenue. These theoretical part is covered in finance management courses, but here I wanted to make everything in a simplified manner for every retail person. I hope you all like this video, investing part 1 and investing part 2. If you like this video, don't forget to share it to all your trading circle, and even this video is suitable for investing people also. Together we grow as an intellectual investing community. Bye.